The current standalone repurchase market fund is being drained at record speed. Now, what are the repurchase markets? When were they created? How are they used? We are going to review this in this short video to get you guys educated on exactly how the Fed is using excess liquidity to plug any single gaps happening in the regional banking space and with any smaller institutions like GSEs who are in current need of overnight operational liquidity.
Throughout the 90s and the 2000s, the Fed implemented monetary policy using, of course, repos and reverse repos. But these weren't the same repo facilities that you're possibly familiar with today. These instead were temporary open market operations, or TOMOs, executed by the Fed's New York trade desk. So TOMOs were short-term loans or securities transactions conducted by the Federal Reserve to adjust the amount of money in the banking system for a limited period of time, typically anywhere between 1 to 14 days. But due to the economic environment back then, whether by buying treasuries with an agreement to sell them to banks at a later date or through selling securities with an agreement to buy them back from banks at a later date, the Fed was easily able to manage plumbing and adjust supply to keep rates close to their target.
In a standard repo, an institution is posting collateral of some kind, whether it be government treasuries, mortgage-backed securities, other bonds, corporate, municipal, whatever the Fed deems as worthy collateral in order to give that institution a loan. This happens consistently. It happens overnight. It happens weekly. It happens on a 6-month basis. On the opposite end, on a standard reverse repo, that is when you as an institution takes cash and parks it with the Fed for a fixed income return on that cash. This usually happens with money market mutual funds that are at pension funds, insurance firms, asset managers of multiple kinds, etc. The standard repurchase rate that you are getting a fixed income return of is derived from standard repo operations. It is calculated at the end of every single business day. So how did the temporary open market operation, or the TOMOs agreements, evolve into what you know today as the standard overnight repurchase agreements?
And it all started with the 2008 Great Financial Crisis. So post 2008, we of course had QE, or quantitative easing, where the Fed injected trillions of dollars of reserves into the system. So by this time, most banks had way more reserves than they actually needed. The Fed began paying interest on reserves, or IOER, a fixed rate that banks could earn just by leaving money parked at the Fed. And here's the thing, only depository banks could earn IOER, or interest on reserves. And GSEs, like Fannie or Freddie, held large amounts of cash, but they weren't eligible to earn that interest on reserves, or the IOER.
And this is the mismatch that caused the TOMOs to stop being effective, because essentially the larger institutions, the big banks, the GSIBs, are the only ones that could effectively use the quantitative easing money that was flushed into the system after the 2008 financial crisis. The smaller institutions, regional banks, GSEs, tier 3 banks, etc., were still feeling the liquidity tightening from the crash and needed a new vehicle to obtain overnight liquidity like the larger institutions so they could conduct their day-to-day operations and remain solvent. Enter 2013, the birth of what you know today as the overnight repurchase agreements market.
So when the Fed launched the overnight reverse repo facility in 2013, it gave those GSEs and those money funds access to a safe place to park their cash directly at the Fed, just like the banks. So that meant that GSEs no longer had to lend to banks for 0.10%. They could lend directly to the Fed at, say, 0.25%, the RRP rate. And this pulled up all the short-term rates and made the floor solid again, which was the Fed's goal.
It basically leveled the playing field. So instead of going to larger banks and institutions for a lower rate where they were able to park their money market mutual funds money at, they were now able to go to the Fed and get that higher rate that the larger banks and institutions were already getting with the TOMOs back to 1990. Okay, so where are we in our current markets and our current overnight repurchase agreement facility? Since the COVID low in 2020, the Fed printed $4.7 trillion in quantitative easing. This was split up between $2.5 trillion that went into bank reserves and $2 trillion that went into the repo. As you guys can see on our Fred chart here of overnight repurchase agreements, the repo markets topped on December 30th, 2022 at $2.5 trillion. Now, this money was parked at the Fed because Powell started the fastest interest rate hiking campaign in stock market history, 11 hikes in a total of 3 years. This left heavy doubts of uncertainty where equity markets were going to go. So it was important that money market mutual funds received a fixed income return that was consistent around that 5% level. And this is what the repurchase markets were giving during this period of time. As you guys can see in the chart, the repurchase markets went from a high of 2.5 trillion December 30th, 2022, all the way down to 4 or 8 billion by October 2025. So why did this happen? And it all comes down to government spending. In June of 2022, the government had their spending bill upgraded, in which they were able to now pull money from the Treasury through bonds that were issued and spend nearly infinitely on an uncapped spending bill for the next 3 years. So what this did as Powell's hiking campaign was continuing with his 11 hikes was raise interest rates on the near end of the curve. This is your maturity bills that are anything from basically 2 years and sooner. The 6-month government Treasury bill that was being issued for government spending was around 6% at the time. And as you can see here, pulled up in TradingView, it peaked at 6.1%, which was much higher than the 5% return rate that you were getting at the repurchase markets. The consistent decline in government 6-month T-bill yields was because of the higher demand in government 6-month T-bill bonds. And this was the number one reason why the repurchase markets dropped from 2.5 trillion all the way down to 8 billion in 2025. Once the repurchase markets hit that near zero level in the middle of summer 2025, the Fed came to save the day. They implemented an emergency standalone repo facility worth $550 billion of liquidity that banks could pull from in the near term because the repo markets were no longer a viable option. And this shows the spike in Treasury securities purchased by the Federal Reserve in temporary open market operations that is happening currently from that emergency repo fund. Currently, that fund is down $100 billion and it has only been open for 1 week. This is eerily reminiscent of the 2019 liquidity issue that happened pre-COVID, in which the repo rate spiked aggressively and it was blamed narrative-wise on corporate taxes. When the liquidity in the banking system is constricted, the repo rates and now the new SOFR rate, which is market heavy, will spike together. It is in these periods of stress that you know something is going to happen with the equity markets or with the Fed in order to ensure that the banking system, whether it's regional banks or GSIBs, stay solvent.
Now, understanding the history and the background of how bank liquidity works is very important for traders to understand. So if you enjoyed this video, please make sure to subscribe to our YouTube channel, follow us on social media across Instagram and TikTok, Twitter, and have a great rest of your day.